Hello and welcome to a brand new edition of Inside Out on the Road, a show where we'll focus on individual stocks with in-depth analysis, deep dive into the financials and tell you about the key risks and triggers going forward. So let's not waste any time on the show and get to our first stock today. My colleague Nigel travelled to Jaipur to get chatting with the management of Shree Cement and gets us this very special deep dive.
Well, the cement industry has caught everyone's imagination. So Inside Out on the road, well, we decided to visit Jaipur and we're currently at Shree Cement's BOR unit, which incidentally is their first unit that they commissioned many years back. Well, Shree Cement in terms of a stock price in the last 1 month or so, it's been an outperformer. Last 1 year, it's been a relative underperformer, but that doesn't take away from the fact that they've created big wealth for shareholders in the last 1 to around 2 decades or thereabouts. Well, on the capacity addition front, they moved from around 4 million tons towards 50 million tons, and now they're headed towards 80 million tons. That's the target that they have on their mind for by 2030 or so. What's more important is they have been growing at a faster rate in comparison to the industry, and they've been adding capacity at a lower than expected cost on a per ton basis. In terms of their geographic sales breakup, bulk of their sales are in North India, followed by East India, and then it's distributed, to the remaining of the country, which is a rather small portion as of now. Now, Shree Cement enjoyed peak valuations. Why is that? As I told you earlier, they added capacity at lower capex in comparison to the industry, and they've also been pioneers on the cost side of things with regard to implementation of WHRS, with regard to usage of pet coke, and also the split grinding model. The problem now is they can't add more WHRS, and some of their peers, they're catching up and bridging the cost gap as well. So from more than 1,000 rupees per ton on a unitary cost advantage, that's come down to nearly around half of that. And Shree Cement's Ebitda per ton, which was nearly around 1,500 rupees per ton, well, that's gradually started drifting lower. And now some part of the street believes that UltraTech Cement's Ebitda per ton will overtake that of Shree Cement. ACC in Bhutra as well with the new promoter, well, they're likely to play catch up on the Ebitda per ton front. The other question that the street wants to know is whether or not these peak valuations, well, they can be maintained and will they be justified? Another aspect the street is waiting by for is how are they going to utilize cash? Remember, they raised the QIP to the tune of close to 2,400 crore rupees or thereabouts, but utilization really hasn't been up to the mark. They're sitting on a cash balance of close to around $1 billion approximately, and the street is waiting by to see whether or not they're going to pursue some inorganic growth. So clarity on that aspect is something that we'll be looking forward to because their return ratios have got diluted. To answer all of these questions, well, we're getting chatting with the management of Shree Cement. Mr. Bangur is waiting for us. Well, Mr. Bangur, the stock market believes that things are going to look up for the India cement story from here on, particularly the second half of the year. They believe that demand is going to be strong, volumes will spike up, pricing will move up as well, and input costs will cool off. Are you in that camp?
So many factors. We may be agreeing to something may not be agreeable, but the bottom line will definitely inflate. The point is the profitability. That has to go up.
All right, so you're in the camp that believes that yes, India's cement's demand story is in a sweet spot and we'll take that. But could you put a number to it for the next couple of years, say for FY23, what kind of a demand growth should the cement industry see? And maybe if you could forecast FY24 as well, because we'll be getting into yet another election year.
8 to 10% CAGR here for 3 to 4 years is what is, I will say.
Okay, all right. So 8 to 10% growth for the next 3 to 4 years is what you're seeing. What about for your own company? Historically, you have grown at 1.4, 1.5 times odd. If I look at over a longer time horizon, do you continue to outpace the industry growth? Is that what you believe?
As the industry, I expect to grow at 8 to 10%. I should grow at 10 to 12% to make both the equations right.
normally Shree Cement was always the leader, whether it was with regard to pet coke usage, whether it was with regard to waste heat recovery system as well. You all were always first. Now the industry seems to be catching up. What are the levers that you have in place, to hold on to that leadership on the cost side particularly?
Now we are going for more and more solar and wind power.
Renewable as a percentage of your power usage, how much is it currently? I believe that the WHRS, for the current capacity, you're almost at the tilt. So you can't really expand for the current capacity, WHRS systems. For your expansions, you can do that. So as a percentage of your total power mix, what is it currently, and where do you see that number headed?
WHRS and renewables put together, it will be around 55%.
Well, Mr. Bangur, we can see that you're constantly focusing on the solar side and the renewable side of things as well, as you mentioned. But the point that the stock market wants to know is, you have been the leader on an Ebitda per ton basis. At one point of time, even if it was for a few quarters, you were doing 1,500 rupees per ton. That number has come down to around 1,200 rupees per ton. And some of your competition, the gap that you had with the Ultratechs of the world, ACC Bhutra cements as well, that's likely to narrow a little bit. What's the steady state Ebitda per ton you're looking at? Keeping in mind volumes are going to pick up, you have costs that are cooling off as well, and your focus on the renewable side and the cost saving side.
Ultimately, the product, when we started the unit, the Ebitda of 300 to 400 was very good. But continuously inflation in the putting up of the plant is there. So the new plants which are put up will not survive below 1,500. So in a very short time, you will say 1,500 to 2,000 rupees Ebitda in 3 years' time. That will be norm. Old norms of 400 to 600, 600 to 1,000, and then continued up to 1,200. The 1,500 was also a abnormality, and 800, 900 also is an abnormality. So it has to be about 1,200 to 1,500 now, and in 3 years' time, 1,500 to 2,000.
But Mr. Bangur, you have been the leader on the Ebitda per ton basis. So irrespective of what happens with the industry, that numbers that you're giving us, 1,000, 1,500, 2,000, that could be a rather movable factor.
Right.
But will you continue to remain the leader on the Ebitda per ton basis? What is your belief? You have been the leader for the last few years. Can you hold on to that number one position?
Not very sure, but we will be one of the first 2 or 3.
Mr. Bangur, you mentioned competition a couple of times, and I'll get to the consolidation bit in just a bit. But there is likely to be, a churn at the top level managements. You have a new player coming in terms of Adani, and there could be a lot of talent that's on offer. Are you looking at strengthening your team, your core committee that you have? Is that something that you have already started discussions with? I'll tell you what. We pick up, a lot of news that maybe, in fact, Shree Cement is looking at a top-level rejig, and there is some of that talent that's already in conversation with you. Your take?
We are definitely in discussions from many companies,
right,
and we'll come out with a very powerful team.
As of now, we already have, a bit of a roadmap. You're at, around 45, 47 million tons odd. You'll be moving to around, say, 56, 57 million tons in the next 2 to 3 years. But your target is 80 million tons. So what is the preferred area you want to go to? North and east is something that you have already, been in for quite a long time. You have moved a little to the south. So what would be the targeted geography you're looking at? And also, earlier you were building rather than buying. Do you want to change that strategy now? Maybe Shree Cement looks at more buying than building?
No, Shree Cement will always be interested in building. We have 2 or 3 mines at various stages of clearance, various stages of land clearing. So we don't normally announce much before the thing really happens. So those will come up in north and south. East we have already got enough capacity.
Right.
So north also capacity will be needed.
Right.
The industry capacity utilization in north is very high.
Right.
So at south we have low presence, but the industry capacity is low, but still will come in south. So north and south we are looking at.
North and south. Okay.
And
what about central India?
Central India unfortunately doesn't have much limestone. There we have to have a buy.
Okay.
There the build cannot work.
Okay. So are you in talks with anyone to buy any central asset, any cement manufacturer in this center?
That is not for the interview. If we are in talk, still we will not be in talk.
But Mr. Bangur, I need to probe you a little bit more. So out of this added capacity that's coming on stream, you're saying you're looking at South clearly. You want to hold on to that dominance that you have in North India as well. And Central India, since limestone is an issue, if you have to expand out there, then you'll be looking at some inorganic growth. Are we getting that correct?
Ekdam correct. Now we are little more aggressive in our approach compared to the past. Compared to the past, we are now ready for, depending on the location, somewhere between $100 to $120 would be a good acquisition.
There are plenty of assets, sir, in that range. I've seen assets at $60, $70 as well, which are listed on the stock exchange right now.
They are the stock exchange prices, but once you want to have a controlling interest, the prices changes dramatically.
Have you tried?
It changes. That we have seen most of the places where the stocks are not well discovered. The MACC, Ambuja, Ultratech, Shree, the prices are well discovered. There cannot be much uptake. There are many small companies of 60 to 70 where you are saying they are underpriced on the market today.
Right.
So once somebody wants to look at them, suddenly the price will increase. The prices have to be reasonable.
Right. In the past, you have been an investor as well in various companies, and the stock market gets very excited when they see Mr. Bangur's name coming up in any cement company. But you have said that this is a financial investment that I've made, like Orient Cement. Before we get to Shree Cement on the lookout, personally, I mean, any of those companies are looking good from an analyst perspective?
Analyst perspective, they have to work, but I feel less than $60 is one thing, including the loan on them. If the enterprise value is less than $60 per share, it is, or per ton, it is a very good buy. But you may have to wait or may not have to wait for 2 years or so, which is a minimum in the investment world.
Well, Mr. Bangur, we have got your investment thesis and your investment philosophy. But the stock market will really be wanting to know a couple of aspects. There's been so much of rumors, a lot of buzz as well about inorganic growth. So let's ask you point blank. Any discussions with India Cement or Sanghi Industries?
Not that of any use. Not of much purpose. Small discussions from the, not directly, through asking. At that time, both of them were not interested. So we never pushed them.
Okay. But there has been no further conversations with regard to Shree Cement going ahead and maybe buying out India Cement and Sanghi Industries. And the only reason, sir, we are asking you this is because the stock market is a buzz. So you said that there was a bit of an approach, but they weren't willing to sell. Is that, are we getting it correct?
Yes, you are getting it correct. But that was just asking them, are you in the market to sell? They said, we are not in the market. And there the matter ended. So it was not that I want to buy was never the word.
Okay, all right. That's a big clarification that's coming in there. So you believe as of now, both those two are not on the block?
At that time. That was some time back. So whether they will be ready to sell or not, because there is no point in any unit where you take a bid from the market, do some here, there. If the present promoter is not willing to sell, no use looking at that asset.
But if they are willing to sell, are you a ready buyer?
We will. That's why we are a possible buyer. Ready means we don't know what the price is, and then readiness cannot be there without price.
Okay, all right. That's a fair clarification. What about Prism Cement? There was some other buzz about that. Prism Cement or any other company that you all could already be in conversation with?
No, there are a lot of things are the stock market buzz.
Right.
Because Prism Cement, they are doing well. They are a growth-oriented group. To think that they will sell, not there. No, nobody said that they are selling.
All right. But are you in conversation with any other unit, here in India? And if you're in conversation, if you're looking at a target, what is the size you're looking at? Are you looking at least 5 million tons? Are you looking at 8 million tons? Are you looking at a bigger number?
No,
you must be having a targeted capacity in mind.
Targeted capacity is not the point. Point is, we are looking anything between 1 million to 10 million, depending on the limestone what they have. If the limestone is high, capacity is 1 million, doesn't matter. It can be any time increased. So we are looking at the limestone size. It should be at least about 100 million ton of limestone,
Okay.
which should be available, and then the capacity doesn't matter.
So as of now, you're saying that Shree Cement is not in active conversation as of now, but you're on the prowl.
Yes, that is the right word.
Let me flip the question. Suppose you get an offer to be bought out. I mean, I'm sure you never thought of it, but what if that happens?
Till we are able to add value, there is no point selling. So till now the market is having a faith on us. We are doing well, and not that people will definitely put offer, but we are not in the market as yet.
All right, you're sitting on a big cash balance, plus you're generating operating cash flow as well. Now you're sitting on close to around $1 billion of cash in your books. The street would be happy, and as you said, stock market puts a lot of faith on you. If you pay out, say, a one-time big dividend or return the money in some way to the shareholders rather than sitting on it, that's provided there's no inorganic growth. So is there a plan to distribute some of that cash? And I ask you this, Mr. Bangur, because you would know it better than me, that your return ratios are getting diluted.
I appreciate it, but as we have the interest to take over the units, have a inorganic growth, that's why we are keeping the cash. And this is necessary, otherwise you lose options. So we will be keeping it. Dividend can be little bit better or not, but that is not going to dilute us substantially.
Okay.
As far as the growth, what we are generating, little bit more or almost equal.
Yeah.
We are investing continuously for our present growth.
Right.
But definitely in a year or two, somewhere part of this money will be used.
That'll be interesting, because otherwise you have been there in the market, but you have not really been very aggressive on the buying front. But as you said, now you're keeping your ammunition ready, and if there is a chance, you're set to fire.
Right, you are.
Well, it's been an absolute pleasure talking to you, Mr. Bangur. Thanks so much for speaking to us here on CNBC-TV18. Wishing you all the best with your plans.
Thank you, sir.
All right, that was an interesting deep dive into Shree Cement, but time to slip into a short break. We'll come back with another interesting stock. JK Paper is in the Swotlight on the other side. Stay tuned. Welcome back. This is the Swotlight segment, and I thought we'll focus on the paper sector this time and understand the value chain and put Swotlight on JK Paper. But first, to the basics. How is paper made? Via pulp. And how is pulp made? Via cotton fiber, wood fiber, etc. So if we look at the value chain, wood, logs, chips, they are processed at pulp mills, which can be mechanical pulp mills or chemical pulp mills, which is then sold to paperboard mill, and then you get various kinds of paper there. So when it comes to JK Paper, it is an integrated paper manufacturer and has products like office and copier paper with 28% market share. There's coated paper with 10% market share. There's writing and printing paper as well. You have packaging board with 19% market share, some of the products. In terms of capacity, the total saleable capacity is 761,000 tons per annum. And since I said they are integrated, they also have pulp capacity of 475,000 tons per annum. In the saleable capacity, highest is from uncoated paper, which is followed by packaging board and then coated paper. Now to the financial performance. Company's revenues in last few years have been volatile, FY20 and FY21 understandably so because of the pandemic. But Q1 has been stellar. Even in terms of margins, they broke out in Q1 with 30% margins coming in this quarter itself, and profits almost doubling in FY22 due to lower finance costs and lower taxes as well. Now, important to note here, industry margins are at 20 to 24%, but integration for JK Paper has helped company with higher margins, sustenance of which needs to be seen. Company exports 8 to 10% of total volumes, but prices in both the markets are largely similar. But company's focus largely is domestic markets. Capacity utilization for the company in FY22 stood at 104.1%. and company has been on a big capacity expansion spree. The company has grown over 5 times in last 17 years. In 2005, they entered coated paper. In 2007, they entered the packaging board segment. In 2013, they expanded to uncoated paper capacity. And in 2018, they had acquired Sirpur paper plant. And that's why that big jump in capacity in 2020. Then they saw expansion in packaging board capacity, taking it to 761,000 tons per annum. With this also came need for more debt. But then now, most capex has been done and company has been able to reduce debt from higher levels. Now it is around 1,000 crore rupees. What are the triggers going forward? The company in its own admission says the packaging board demand is very strong and except for coated paper, imports for other categories are very small. So demand should remain intact and that they are booked in terms of volumes for the entire year. On balance sheet, they expect to reduce debt by 300 to 325 crore rupees every year. The company does not expect price correction and no major rise in input costs, and since no additional capacity is coming in the industry as well in the near term, prices according to the company should remain firm. However, it is a cyclical sector when it comes to product pricing. But this company is integrated, so they are insulated to some level. The industry as a whole does not have formal contracted volumes, so that is a bit of a risk, and 50 to 60% of quoted volumes are imported, so that could be an issue as well. Promoters, they hold 49.63% stake with L&T Mutual Fund holding 3.45% stake in the company. The stock, even after this sharp run-up, is very cheap at 10 times FY23 forward earnings. So that is all about JK Paper and the paper industry, but we have run out of time on this episode of Inside Out. It's a goodbye from Nigel and I. But do write to us and tell us the companies you want us to discuss and you want to hear about, and we'll feature these on our show. Thanks a lot for watching.